Warren Buffett is worth over $100 billion. If you had put $10,000 in his company, Berkshire Hathaway, back in 1965, you'd have more than $300 million now. That's a big increase from a small start. Warren Buffett is a very successful person in the world of investing. He's the boss of a big company called Berkshire Hathaway. He started buying stocks when he was just 11 years old. Since 1965, his company's stock has grown about 20% each year. That's 2 times better than the average growth of the stock market, which is around 10%. So what's the secret to Warren Buffett's success? It's not luck. It's something simple but powerful called compound interest. This is the kind of interest that keeps growing over time, making even a small amount of money become a lot more. By the end of this video, you'll understand why compound interest is often called the 8th wonder of the world. You'll learn how Warren Buffett, one of the most successful investors ever, used this simple yet powerful concept to build his fortune. We'll also show you how you can apply the same principle to grow your own savings step by step. What is compound interest? Compound interest is the financial principle where you earn interest on both your initial money and any interest you've already earned. Think of it as a snowball effect. Your money grows, and then that bigger amount grows. Imagine you invest $1,000 in a savings account with a 5% annual interest rate, compounded annually. After 1 year, you'd have $1,050, but here's where the magic happens. In the second year, you earn 5% not just on your initial $1,000, but also on the $1.50 interest from the first year. So at the end of the second year, you'd have $1,102.50. Now let's say you leave that money untouched for 20 years. According to calculations based on data from the U.S. Securities and Exchange Commission, you'd end up with approximately $2,653.30, even if you never add another penny to the original $1,000. That's over 2.5 times your original investment, all thanks to compound interest. Compound interest isn't a new idea. It's been around for a long time. The concept dates back to ancient civilizations like Babylon, where it was used in agricultural loans. The idea was simple. If you borrowed seeds to plant crops, you'd repay more seeds after the harvest. This extra amount acted as interest. Over time, the concept evolved and became more refined, but the basic idea remained the same. According to a study by the National Bureau of Economic Research, compound interest plays a critical role in long-term financial planning and wealth accumulation. It's the engine that powers many investment strategies, helping both individuals and institutions grow their wealth over time. In the 17th century, mathematicians like Jacob Bernoulli began to study compound interest more formally, giving us the mathematical formulas we use today. These formulas were quickly adopted by financial markets, and they've been a fundamental part of finance ever since. So from ancient fields to Wall Street trading floors, compound interest has stood the test of time. Warren Buffett and compound interest. Warren Buffett was born in Omaha, Nebraska in 1930. From a young age, he showed an interest in making and saving money. He bought his first stock when he was just 11 years old, investing in City Service Preferred at $38 per share. This early experience taught him the value of patience in investing, a lesson he would carry with him throughout his life. Buffett's investment strategy is all about long-term growth, and compound interest is a key part of that. He looks for companies that have a durable competitive advantage and hold on to them for years, sometimes decades. In his letters to shareholders, Buffett has often emphasized the importance of holding on to investments to take full advantage of compounding. For instance, in his 2016 letter, he mentioned that his longest-held stock, Geico, had been in his portfolio for over 60 years and had returned a compounded annual gain of 11%. One of the most famous examples of Buffett's use of compound interest is his investment in Coca-Cola. He first bought shares in the company in 1988, investing about $1 billion. As of 2021, that investment had grown to be worth more than $22 billion. That's an annual compounded rate of approximately 9.5%. He first invested in American Express in 1963, following a scandal that had severely depressed the company's stock price. He saw the fundamental value and brand strength of American Express and decided it was a good long-term investment. He invested about $13 million, which was a significant portion of his partnership's capital at the time. Today, Berkshire Hathaway owns more than 151 million shares of American Express, valued at approximately $25 billion. The Rule of 72. The Rule of 72 is a simple way to estimate how long it will take for an investment to double in value at a fixed annual rate of return. To To use it, you divide 72 by the annual rate of return, and the result gives you the approximate number of years it will take for your investment to double. Warren Buffett is a big fan of simple rules that give him an edge in investing, and the rule of 72 is no exception. He uses it as a quick mental calculation to assess the potential of an investment. It helps him understand how long it will take for an investment to double, which is crucial for his long-term investment strategy. In a 1996 letter to shareholders, Buffett wrote, "The rule of 72 is a useful shortcut for evaluating the long-term worth of investments. So, let's say you have an investment that offers a 6% annual return. Using the rule of 72, you divide 72 by 6, which gives you 12. This means it would take approximately 12 years for your investment to double." How you can apply compound interest. You don't need a lot of money to start benefiting from compound interest. You just need to start early. The earlier you begin, the more time your money has to grow due to compounding. Let's consider two people. Alice starts investing $100 a month at age 25, and Bob starts investing $100 a month at age 35. Both earn an annual return of 7%. By the time they're 65, Alice will have around $263,000, while Bob will have about $122,000. That's a difference of $141,000, all because Alice started 10 years earlier. If you're new to investing, there are many tools and platforms that can help you get started with compounding your money. Online brokerages like Charles Schwab or Fidelity offer user-friendly platforms for beginners. Robo-advisors like Betterment or Wealthfront can also be a good option as they automatically reinvest your earnings to maximize compounding. Compound interest can significantly grow your wealth, but it's not without risks. Not all investments compound equally, and market volatility can affect returns. Warren Buffett lessens these risks by choosing stable, long-term investments. In an interview with CNBC, he said, "I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later, one will." His strategy focuses on reducing the impact of market fluctuations and maximizing the benefits of compounding. Compound interest helped Warren Buffett grow his money a lot. You can do it too. Buffett once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." If you liked this video, please hit the like button, share it, and subscribe for more good stuff.